What's going on, cash flow hackers? It's Chris with Life 180, and today we are doing a live just talking about how to invest with the world of interest rates going up. And I hate to say this, but right now I am really excited to say that this is kind of fun. I guess I'm kind of ashamed to admit this, but it's kind of fun for me because this is something I've been saying was coming for a long time. There are a lot of parts of me that didn't necessarily think it was going to happen because the bottom line is with interest rates going up, ultimately it puts a lot of stress on the economy. Because it took so long, I think here is the problem. It took this long, and because we didn't deal with the consequences immediately when we should have dealt with them, ultimately what happened is we didn't kick the can down the road to deal with it. We kicked the can up the hill to a higher cliff to fall from, right? And, the bottom line is, I guess, if you've watched my content and you've seen me talking lately about the correlations between the 70s and the 80s, or the late 70s, early 80s, to kind of the environment that we've been in for the past couple of years, it's extremely relevant. It's extremely real. William Jackson, hey man, what's happening, man? Good to see you on here. Thanks for being here. So if you look at what's going on as far as in the economy right now, we can compare it back to the 70s, late 70s, early 80s. Inflation is kind of getting out of control. But like I've said, it's you have to take a look at this and not think about, okay, what have I been doing for the past decade? We have to think about when the environment changes, how do we have to change our strategies to achieve our goals and objectives that we have for our lives, for our businesses? Maybe you want to be a real estate investor. Maybe you're an entrepreneur. Maybe you just want to invest in the markets and find the right value stocks or the value plays to kind of get involved with. And the challenge is a lot of those things have changed over the years in the market shifts, right? And right now, because we've had this massive shift, if we think about it, remember, COVID shifted everything and it kind of accelerated a lot of these things into play right now. And what we need to do is we think about going into this environment where a lot of people are freaking out right now, where interest rates are going through the roof. Interest rates are 5.5% to 6% right now on a single family home, right? Like literally back in December, not even 5 months ago, interest rates were in the 3% range. So they've almost gone up 100% in about a 5-month window. So if you think about it from that perspective, most people would say that, man, that is a recipe for disaster. But it's also important to note that the real estate market and the interest rate market associated with real estate isn't really tied to the federal funds rate, right? So all this talk about Jerome Powell wanting to raise the federal funds rate, that has not really much to do with the real estate market directly. Now, what I will say is that if the federal funds rate goes up, what will happen is when that federal funds rate goes up, that typically will have a trickle-down effect to the bond market as well. So the treasury bonds, which is ultimately what has the impact on the real estate market, on the mortgage market, will have an impact. But it's not an immediate thing. The important thing to know there as well is that the rates don't have to go up very much. Like look at the federal funds rate has only gone up like quarter basis point recently. And that raise, I mean, we've had the 10-year treasury bonds have gone up significantly. The yields in those have gone up significantly. And that's what's made the mortgage rates go up at the rate that they have. Now, what I think is important to say here to kind of get back on topic here is when we talk about rising interest rate environment, we have to kind of think about what is it that the function, like what are the attributes of these investments and of assets that we're looking to put our money into, whether we're looking to save our money and store our money and keep it safe, or whether we're looking to invest and take risk and try to get returns and try to, accomplish these bigger goals. And I think what's going to happen here is anytime we have these major shifts, we get a lot of volatility. We got a lot of fluctuation in the markets, right? And so we have to look at that and we have to try to take advantage of those environments and prepare for those environments and become what I would call an opportunistic investor. And so what I want to do here is I want to set the stage a little bit because, and I know if you've watched this channel before. This is going to be a little bit of a repeat, but I think it's, even if you've seen this, I think it's really, really important to understand this and to really internalize it. And what I want to do is I'm going to go to my whiteboard right quick right now. And I want to go through here and I just want to talk about, I'm going to pull my microphone over here for me. What I want to do is I want to talk about the fact that we're in this environment where if you go back to the 70s, let's just call it 1979, right? And 1980, interest rates were high. We'll call it 19% because that's where the federal funds rate got, right? And so the interest rates were here and then they trickled down, right? And then they went over here. So 2009, right here. And then they've been flat ever since, right? So what happens is now we've been living in this environment. So even though interest rates have been low, what's important to understand is that with interest rates being really low here, we've also had low inflation, but we've kind of had artificially low inflation. And we've also had quantitative easing, 1, 2, 3, and then we had COVID money printing, right? So when you account for all that, just think about 40% of the money circulation ever printed in the United States in general, 40% of it has been printed in the last 24 months. So that is a scary number. And that is why when we have that much money that goes into circulation right here, we have to do something. If you understand Keynesian economics, you understand that when inflation gets high, which is what we've done with low interest rates, with money printing, we've run out of ammunition. So for 40 years, or 30 years, I guess, from 1980, 1979 to 2009, we leveraged every arsenal, every tool that we had in our tool belt to be able to stimulate the economy. We were able to reduce these interest rates. And what happened is that when interest rates go down, assets go up. That's just the way it works, because interest rates going down makes cost of borrowing cheaper, so that makes it so the same person that can afford the same cash flow can actually afford more. And so then therefore the asset values like real estate, cars, and debt gets cheaper, so businesses invest more in themselves and all that stuff. And so there's a lot that's going on. So we had this negatively or declining interest rate environment, which is a positive for the economy in the short term. But then we had the financial crisis in 08, the Great Recession in 09, and then we had this period of time of money printing and so on and so forth. And so now what's happened is we ran out of this ammo, interest rates are low. By the way, 1979, at the beginning of 1979, interest rates were 6%, right? They got jacked right up to 19% virtually overnight. And so this is after a window of a period of time where inflation rates were still high for a prolonged period of time. So from 1974 to about 1979, the average inflation rate was 9%, just over 9%. I think it was like 9.04% from 1974 to 1979. So when you look at that, when you look at those numbers and the statistics, this goes to show me when I think back at it, I'm a big believer history has a habit of repeating itself. I'm a big believer that we're going to run into this environment where interest rates, or inflation, I should say, is going to go higher. Now, the federal funds, the chairman of the Fed, Jerome Powell, just said that if they have to shock the markets, they will. And they even threatened to going up to 5%, which is, I mean, it sounds drastic because it would create probably a recession to an extent. But, it's ultimately what we need. I don't know when this is going to happen. I do believe that there is going to be an uncorrelated movement, right, between the real estate market and the stock market. And the reason I say there's going to be uncorrelated movement is because stocks are going to be much more drastically impacted immediately. I think real estate has a longer tail of the impact that you'll see from it depending on where you are. If you're in productive environments where there's job growth and there's technology sectors and like Atlanta, places where there's corporate development, Phoenix, Atlanta, places like that, I think you're in an area where you're going to be much more insulated. There are going to be certain areas in this country where real estate will really suffer. But what I will say is that I think with the federal funds rate going up, that is going to take money out of the economy. That's going to take money out of the stock markets. It's going to scare investors. It's going to create a lot of uncertainty. And the stock market doesn't like anything less than uncertainty. And when it doesn't have certainty, that's why you're seeing these sell-offs over the last couple of days. I know today, I think last I saw it was correcting a bit. But that's just the nature of this. You'll have these up and downs every day, and that's what causes a lot of volatility. And so, you know what, like that, it's really, it's important to just realize that when these rates go up, it's going to have a negative impact. We don't know the time frame on when that impact will be, right? Like I said, I think stocks will be drastic, and I think it will be much sooner. But I also think that that the real estate market will have a correction in the next, say, 24 to 36 months, maybe 24 to 48 months. I don't think it's going to be right away. But what I do want to do so I do this thing. It's called the Life 180 Pyramid Talk, and what I want to do is I'm gonna take a couple seconds just to explain kind of a theory here, and just a concept. I'm gonna pull this over again. So I want to explain this concept. So if you look at how to save money and kind of how to set up your financial life. What you have to do is you have to build it like a pyramid. And so everybody in the CFP that goes through the CFP endorsement course has to do this, right? They have to go through this process. And so the safe money, this is your, insurances. My handwriting is horrible. I apologize. I'm going to just call emergency fund. This is where your life insurance is going to be. It's your auto insurance. It's your umbrella coverages. It's everything of that nature that you want to make sure that you are protected for, right? That make sure that your life is insulated from risk, right? And that is where the emergency fund comes in. Now, what I suggest to people to do is to create what's called an opportunity fund. Now, this is why this is so important, because with interest rates going up, we don't know if it's going to be this year in the stock market. We don't know where opportunity is going to open up. It may be businesses are sold at discounts. It may be that you have real estate in a couple of years. It gives you a little bit of a window to save. But what I'm a big believer with interest rates going up, it's going to create a completely different market where the most important thing that you need to think about right now is having safe capital that is guaranteed, that you can't lose, because when interest rates go up, it creates that volatility, it creates that risk. So the rest of the people, because this is, let me show you something. It's going to position you to take advantage of the fact that most people in this world, in this country, in North America specifically, are positioned not well. They don't have their financial life designed to take advantage of these opportunities. In fact, they're very much like 2008, where most people just got destroyed financially. And it's because of this. It's because most people have their life built upside down. And when they're told to save for retirement, what they're doing is they're not saving for retirement. They're investing for retirement, and they're putting all their money. They're told the younger you are, the more risk you can take. They go out, they invest in these target date funds, because they got all this stuff. But they got all these plans of retiring and putting their money in their 401ks and giving up control of it, and none of it makes any sense. But they do this, and what happens is they don't have an opportunity fund. They don't have an emergency fund. And if you listen to people like Warren Buffett and these entrepreneurs, they make money when the opportunity waves come. And what happens is, because of the fact that most Americans don't have any safe money, right? So I read a statistic the other day, 64% of Americans don't have access to $500. I can't write right now. They don't have access to $500. That's the point. 64% of Americans don't have access to $500 right now if they need it for emergency. That is a scary, scary, scary statistic if that's the case, right? Like, so let's just say it's even 50%. That's extremely, extremely scary. So what happens when interest rates go up, and it creates stress on the economy, and it makes asset prices go down, and it puts pressure, and the cost of borrowing and lending for businesses goes up. And and the fact is, you look around us right now, and we have all these taxation issues. We have national debt at all-time highs, interest rates at all-time lows. We have all these things going on where the government has to increase their revenue to be able to afford the deficits that we have, because we can't keep just printing the money the way that we are. And so what do we have to do? There is going to be volatility, and the volatility isn't just going to be in the stock market. It's going to be in businesses. You're going to see it in the unemployment rate. There's all this stuff going on. So what happens is if the economy goes through a bad swing, people lose their money and the market falls over, and then people start at zero and they become desperate because they have no income, right? They have no income, they have no assets, they have nothing going on to protect them. So these guys struggle, and anybody over here with money in this safe that has their financial life built on this big pillar. Think about it like a pyramid. This is why they teach this in the CFP course, because if you have your life built like a pyramid and you're in safety and guarantees and liquidity and control of your money is what you're focusing on, that is where the opportunity is the highest to begin with. And so what you need to focus on right now, the number one thing that you can do in an increasing interest rate environment is to make sure that you save as much as possible. Don't go out and try to invest. Think about it. Right now, the stock market is at an all-time high effectively. I mean, I know it's not today because we've had a couple months of sell-offs at this point in time, but effectively, we are near all-time high levels still. And so how much sense does it make to invest in anything when it's at its all-time most expensive rate? After a 13-year bull market, when historically speaking, after between 8 and 12 years, we typically have a correction, right? And we haven't had that correction yet. And so when we look at this, I think it's really important to see this and say, okay, what's going to happen? Well, I think a correction is in order at this point in time. And I think right now, keeping your money safe, accessible, saving as much as you can, because what's going to happen is, even if you can only get in this safe money, even if you can only save, let's call it 50 grand over the next couple of years, instead of investing, instead of going out and taking risk and putting it over here, even if you can only get 20 grand or whatever the number is for you, honestly, it doesn't really matter. That whatever that is, it's going to be leveraged, because when a correction happens, when these guys have to make bad decisions, it's the pendulum effect, right? I talk about this a lot. And so what happens is, we've gone so far, the pendulum has swung so far to one direction, it's out of balance, it's out of whack right now. And what's going to happen is, when the market corrects, when inflation rates, when interest rates go up and it puts stress and volatility in the market, it's going to cause people to make bad decisions, to force themselves into bad decisions, because they're just going to be focused on survival. They're going to be focused on, how do I pay my mortgage if I can? How do I put food on the table? How do I not get my car repossessed? That's what they're going to be thinking about. And so what these guys are going to be doing is, they're going to be making bad decisions. That's going to put things at fire sale prices. You're going to find real estate at fire sale prices, businesses, stocks are going to be discounted. There's going to be a plethora of opportunity for people who are prepared for opportunity. That's why right now, my biggest focus right now is teaching people how to become an opportunity investor, an opportunistic investor profile, because that is what's going to help you catapult yourself forward to get the results that you want in your financial life. It's that clean. It's that simple. It really, really is. And so when you do this, my suggestion is where to keep this money. Well, obviously, the big concern for people is inflation, right? Because we have inflation, and inflation is a real challenge. Because what do you do? Like the challenge there is you either keep your money in a savings account and you have access and use of that money, and you lose money to 8.5% inflation. So if you got 100 grand in a savings account, it's not very attractive, because you're losing 8.5% purchasing power. You're basically losing $8,500 in purchasing power with that inflation. So not very attractive. Now, I'm a big believer the market is cyclical. It's not linear. And I always believe that we have to think long term, right? So I'm going to erase this. I'm a big believer we have to think long term, because if you're, let's just say you're 30 years old right now, maybe you're 40, I don't know how old you are, but if you're 30 and you're working until you're 65, you're going to have, well, I did those too long, but you're going to have a couple cycles of, let's call it 8 to 12 years, right? And this happens. Now, the last cycle that we just had with this last 40-year cycle, where interest rates were so high and we came down, and now we're going through this. We had a couple micro cycles in between there, obviously. But I think this is the beginning of a bigger cycle. And so what you do over the next 5 years and how you position yourself is either going to make you or break you over the next 30 years. That's my belief. And I believe people that follow the pyramid on the left that I was talking, I guess depending on what way you're looking at it, but on the left over here, that focus is going to help you accomplish and guarantee that you can be prepared and positioned to take advantage of opportunity when it comes, period. Now, you can't save your money in a savings account ultimately, because if you do, you're losing money to inflation. I get that. But when you think long term, there's one asset and one asset alone that I know of, and I've done a lot of research on this, that will help you beat inflation and give you liquidity use and control of your own money. And that is a properly designed whole life insurance contract. Now, it's important to understand that this is not just any whole life insurance contract. And if you've watched my channel before, you know how I feel about this. If this is your first time here, thanks for being here. Make sure you subscribe and check out my other content on these topics, because it's extremely, extremely important. It's basically a savings account on steroids. And right now, there has never been a more important time than to look into this, because no matter what, I have news for you. You're not going to be able to put your money anywhere where you beat inflation this year. No matter what, you're just not going to be able to do it. But if you look from a long-term perspective and you realize that what life insurance companies do is they manage risk better than any other financial institution on the face of the earth, and their primary focus is preservation of capital. What does that mean? That means they don't want you to lose purchasing power of your money. So they are always focused on doing that. So I don't know about you, but I'd rather put my money into a whole life policy that's properly designed, that I know is going to beat inflation long term, that it's not just for the cycle that we're in, it's for this next cycle and the next cycle, and that if I just follow it, not only is it going to position me well for what's coming up over the next 2 to 3 to 4 to 5 years, but it's going to position me well over the next 10 to 20 to 30 years, right? And I always kind of say that the best time to plant a tree was 30 years ago. The next best time is right now, right? Like it just gets started. And so the biggest thing I can say is if you have any money, any safe money, if you believe you should have an emergency fund, if you believe that right now you should have an opportunity fund, if you're concerned about the equity in your home evaporating with a market crash in the next couple of years, if you're concerned about the risks that you have in your 401k and your qualified plans and your market risk, and you're getting close to retirement, and all these things are things that you're starting to get a little bit worried about, I would say, this is something that you should look into. Getting your money into a place where it can be safe, and wait for the opportunity. Wait for the opportunities to present themselves to you, because I promise you they will. Once again, look around. We have all-time high debt in this country. We have over a $3 trillion annual deficit. We have over $140 trillion of unfunded liabilities. We have Social Security that is woefully underfunded. And we have interest rates at all-time long-term lows, right? And all of those things have been going on for this and building at a compounded rate, bigger and bigger and faster, getting worse and worse. And it's going to hit a head, and it can only go for so much longer until it hits that head. So my suggestion to you is to really think about, what is your exposure? How prepared are you for this? Because I can promise you, this whole economy going to hell in a handbasket, so to speak, the financial crash, the market corrections, all these different things, the interest rates going up, inflation, you can either thrive from that and be positioned to win because you're going to do what's right and you're going to put yourself in a position to win, or you can struggle like most of the people. Robert Kiyosaki says it all the time in his cash flow quadrant talk, is 95% of the people in this world are not going to be prepared for times like these because they're not willing to do what they need to do. If you try to do what everybody else is doing, you're going to get the results that everybody else is getting, and it is abysmal, and it's not going to be something that you're going to be happy with. So that's all I got for today. If you, from an interest rate, with interest rates going up, if you want to be able to position yourself, what it's going to do is it's going to create a lot of volatility. It's going to create downward momentum in the markets. Once again, just to recap, I think the real estate market's got a longer tail before we're going to have that happen. but I do think it is going to happen in the real estate market in 24 to 36 months or so. I think in the stock market, it could happen much, much faster. So any questions at all, comment in the comment section below. Feel free. If anybody has any questions, there's also a link down below. If you want to talk to somebody, we have a whole team on YouTube at least. And if you're watching on another platform, go check it out on YouTube. It's youtube.com/life180. You can go to the description of almost any video that I put out, and there's a link that you can get on with one of my Life 180 coaches to have a clarity call. This is not a sales pitch. This is literally just a value-added clarity call to help you understand kind of what your position is, get some clarity about what your goals are, figure out where your risks and exposures are, and talk about what you can do to kind of plug the leaks in your financial life to make sure that you are prepared for what's coming. So that's it. I guess, hope you guys enjoyed this. I hope you found value. And I guess until next video, have a blessed, inspirational day. We'll talk to you soon. Take care.